Hi, this is James Eng Full Capital, and today's October multifamily financing webinar. The theme is the gap is back. So the gap is back, and so we've been talking about a lot of different gaps, but let's get into what I mean by the gap is back. Okay, so this chart is something that I've been looking at or trying to create, and a lot of people are doing this in different ways. But let me try to explain this chart as easy as possible. All right. So NOI of $1 million on a property, and then the cap rate, right? So we've seen cap rate expansion from when deals were going for $25 million on a 4% cap of $1 million NOI. So that was 21, 22 even. So here's the purchase price on the left-hand side. And then if you were to buy this deal now, and interest rates are here from 4 up to 7, and then cap rates 4 to 7.5. So when you look at this deal right now, if you bought a deal on a 4 cap and the interest rate was 4%, you could get 56% LTV. This is on a standard Fannie Mae Freddie Mac loan. And in reality, what are we seeing right now in today's market is cap rates are expanding. So it's going from anywhere from 5 all the way to 6.5 to 7, depending on A, B, or C. So I just use Dallas Fort Worth as an example. So here you see if you buy on a 5% cap rate and your interest rate is 6%, you get 56% leverage. And as 10-year Treasury has run here in the last 2 or 3 weeks, now you're probably closer to 6.5%. So it drops your leverage to 53%, right? So you're putting half the money down in equity to get this deal done. And some people are still doing that, right? So that's on the Class A stuff. But then as you move out on the curve to from A to B, you're starting to see, all right, well, I'm going to need a little bit more cap rate expansion. So going from 5 to 5.5, and maybe 5.5 to 6, right? So really, if your cap rate equals your interest rate, 6 to 6, then you're pretty close, right? You're in that 67% range. And then even if you go out even further, so if the green is Class B deals, and then Class C deals maybe go at 6.5 to 7, then you can get up to the 70% leverage. And I mean, when I first started in this business in 2015, pretty much every deal qualified for 80% leverage. And some of them was 80% leverage plus rehab. So I'm not saying we're there yet, but that's the direction it's moving. So when I say the gap is back, it's really number one, the gap between A, B, and C. So in 21 and 22, this gap between A, B, and C was like 25 basis points. But now it's increasing probably 50 to 75 basis points at least, maybe even 100 basis points between A, B, and C. So the gap between classes is coming back. The gap between cap rate and interest rate. So a lot of deals were done maybe at 4% cap rate, but the interest rate started at 3%. Now it's up to 7 or 8%. So that's negative leverage. So we're still seeing our now buyers, because of the number of deals that are coming to the market, they are pushing for positive leverage. And if interest rates are sitting at 6.5, pretty much they have to buy at a 7 or 7.5 interest rate. And what that's going to create is a lot of pain for sellers right now if they decide to go right now. The other way, which we'll talk about later, is how else can I get positive leverage is if there's loan assumptions in the 4 to 5.5% range over here, then you can still get positive leverage if you buy on a 5.5 or 6. And this last thing, number 3, the gap between your cash on cash yield, right, as an investor, and the interest rate on treasuries. So this was not a big deal when treasuries were paying you nothing, or CDs were paying you nothing, and your deposits made no money. But now they're up at 5%, 6%, not 6%, probably 5% on short-term 2-year treasuries, 3-year treasuries. So your cash on cash is now competing against that money. And so this gap is back. This was a lot on this chart, but hopefully you got the gist of where you're going. And a lot of times now, people are just very simply saying, okay, what is the tax adjusted, insurance adjusted cap rate? And then what is my interest rate that I get on the loan? So majority of the deals that we're seeing, the interest rate is anywhere from 6.5 to 7% right now. So then if you want these things, if you want a gap between A, B, and C, if you want positive leverage, if you want to be able to give a higher return than treasuries, then you're probably going to need to be in the sixes on your cap rate. And that's going to go across A, B, and C. And some people, they might have a little bit lower interest rate because they're more experienced, or they have a different funding source that's a little bit based on your guarantor background. And if you have, you're going to get potentially a lower rate if you have some of those things, whether it's you put down more equity or you're working with a bank that maybe you have a lot of deposits with. All right, so let's get into, so that was the gap is back piece of it. So let's get into sort of what we're seeing in the market today. All right, so this is the first one. So this has been out maybe a month or so, and this was a syndicator in Houston. So they bought the deal in March of 2022. They had a 2-year loan on it, so not until April of 24, $51 million loan. But when we look at the occupancy history, this is coming from Yardi. If we look at the occupancy history, it just has struggled since they purchased the property. I just looked at the last 12 months. It really, it couldn't get above 82%. And, this is probably a floating rate loan. And whether or not they bought an interest rate cap, I do not know. But even at 80% occupancy at a big price, they just couldn't keep making the payment. So they're going to get foreclosed upon. So that's a $50 million deal in Houston, and relatively new, right? So this is a newer property and it still got foreclosed on. All right, second one. So this is also in Houston, and this one is in an area that is sort of near the airport, near Intercontinental, off of 45 and Beltway 8. And this one was bought in March of 2021. So this is the first one that I've seen where somebody is getting foreclosed and is not a bridge loan. It is a Freddie Mac loan, it appears, and it has a floating rate interest rate. So SOFR plus 267 is the interest rate. And it also had this challenge, right? So it had the occupancy challenge of 80%. It looked like a little bit of an uptick. But if you zoom in on the demographics, which I think people are going to become more and more aware of, is that the median household income in a 1-mile radius of this property is $30,000. And so a lot of times people were buying properties and, the pro forma was saying, okay, we're going to buy it at X and then improve the rents by $200, $300. And in some of these markets, you just can't push the rent that much because of the income. Right. So on this one, it looks like, I think it's this week that it's going to foreclosure. I'm not sure what's going to exactly happen on this one, who's going to buy it and step into this deal. But it is not a maturity issue. It is more a floating rate issue, and it's an operator issue in terms of NOI. Just couldn't get the NOI up from here. All right. So those were two that, were sort of in Houston, and, they did not have time to go, right? Because, foreclosure is really the last place that you want to be as a GP. And, we're seeing this in listings now is, whether it's Oklahoma City, there's a distressed asset, whether it's Lubbock, Midland. So some of the secondary markets, San Antonio. And what you're going to start seeing is that deals that are on the market longer aren't necessarily a better thing. And so what we're seeing is as interest rates go down, the longer you're on the market, the better, because prices keep going up. But since interest rates have been moving up, it's been harder for buyers and sellers to come to agreement on a deal. And so, this one in Midland, this is, the loan is maturing, so they got to go if they can't refi. This one in San Antonio, they're saying, look, we're taking offers right now. So before there was, 4 weeks of tours, there was 2 or 3 weeks of best and final and buyer interview calls. Nope, no more of that. They're just going right to guns, saying, all right, if you have a good offer and you want to close, let's start working on the PSA right now. And let's start going, because the more time we take on these deals, nothing is getting better in terms of time for the seller or the buyer. So when we talked about positive leverage, there's 2 ways to do it. One is you can buy it and put a new loan on it. But now these, fixed rate Fannie Mae and Freddie Mac loans are coming into play, and these are an asset. These might be the biggest asset, right? So we have this deal in San Antonio has a 3.57% fixed, 4.46 over here in East Dallas. This one's 5.14, which probably at the beginning when they looked at this deal, it was not an asset, but now it is, right? So as rates have moved up to 6.5, it has become more of an asset. And this one's 3.02. So I think the one thing that you have to be careful is, yes, you want positive leverage, but you do not want to buy at so low of a cap rate that your cap rate expands on you to a market cap rate. So I think some people will buy the deal at a little bit lower cap rate than market, but you don't want to be 100 basis or 200 basis points under market compared to the chart that I showed previous. So maybe 50 basis points is okay because you're inheriting this asset of a loan, but you don't want to be, you remember, as they always say, basis is forever. So your loan's going to change in the future, but your basis will not change. All right, so this is one of the largest syndicators in the space. I just snapshotted some of, so this is Tides, and look at these deals and the number of deals that they bought from 2021 to 2022, all in DFW. I want to say I can't do the math fast enough, but let's say it's over 10,000 units. Over 10,000 units in DFW, or yeah, it seems like a lot of units. And these are the loan amounts. So these are not small deals. The number of lenders, there's probably at least 10 to 15 different lenders, bridge lenders on here. All their loans were floating rate loans. All of them were bridge loans. And, this was all done sort of at the peak. And so these guys came out. I don't know if they interviewed them or a lot of people were worried that they weren't going to be able to do anything on their portfolio, but it looks like they came out with a press release saying, we've worked out these deals and everything's good. So I don't have inside information on these loans, but it looks like they extended some of the maturity dates. So a lot of their loans maybe had 2-year maturities. So maybe kick the can for another year, and then potentially cutting the interest rate on these deals. So a lot of people, this is going to be a workout between you, the lender, between you and the borrower. And so a lot of these deals, we're going to just have to figure out, number one, what the value is. And number two, can you keep paying? So I think, going back to my GE days, a lot of times if the borrower could keep paying the loan, then we typically did not foreclose. The problem that we ran into is when we did larger multifamily, or not larger office, industrial, retail, some of those deals where you just lost a big tenant and the borrower could not pay, then that's when we had to just foreclose on it. So that, going back to the first 2 foreclosures that we saw in Houston, those people just stopped paying. And so the lender has to do something. They have to foreclose. Whereas a lot of these guys, they don't necessarily want the property back. So if they can keep paying their interest, then they'll probably give them a little bit more time on these deals. So, all right. So this was sort of a recap. So now you've seen sort of where we got this and sort of where the market is and how this gap is coming into play across the markets. So this was an interesting piece that came out of Marcus and Millichap, and they're looking more at the fundamentals of what they're seeing across rent growth and construction. And you can see that pretty much everything in red is negative rent growth. So all the places with a lot of supply coming on, the yellow is probably neutral. And then green is where they're seeing the most sort of rent year over year growth. And so you're seeing it mostly in the Midwest and maybe the coast. But a lot of these here in Texas, Dallas, Fort Worth, and Houston are just sort of neutral. And then Austin, San Antonio, I think the amount of supply coming into those markets, and then maybe a little bit on the tech side, their rents are going down right now. Transaction activity with the federal funds rate moving from basically 0 up to 5.5, 5.3. Now transaction activity has pretty much been at its lowest. I guess the lowest was in second quarter of 2020 when you can't go outside your house. But just in the last 5 or 6 years, it's been sort of a steady in terms of number of transactions. And the last two quarters have been the lowest in a long time. So, I think in terms of apartments, this piece of it is still in play. In terms of, are your residents moving out to buy new homes? And that is no. The cost of the new home plus the financing, this gap is the biggest ever between the two. All right, so we've gone through existing deals, what's going on in the market, what's coming to market in terms of deals. Next, we're going to talk about sort of DFW deals that have closed, which is just to give you an understanding of what's actually getting done, the upcoming maturities, and then we're going to talk about financing. So here is a just sort of a snapshot of what has actually closed in DFW and how they got these deals done. So you can see the green is pretty much agency. Bridge, there's still a couple bridge loans out there on some of these larger deals, but mostly Fannie Freddie. And then you go over to August, you see one bridge loan, couple four or five Fannie Mae's, and then a loan assumption. And then if you get into September, we see a loan assumption and more Fannie and Freddie and one bridge. And so I wasn't able to get all the loan details on a couple of these, but I mean, from what I'm seeing on what people are utilizing, it's really agency and loan assumptions right now. All right, so this is what everybody, I've tried to slice and dice this as many different ways as possible. This shows DFW maturities, loan maturities in the next 15 months, so till the end of 2024. And when you look at this, majority of the deals, so the number of loans, right? Majority of the deals are larger deals, right? So the biggest component is probably 200 to 300 units. And then most of them are 100 to 400 or 500 units. That's where most of the maturities are coming. And not necessarily in the smaller and not in the really big stuff. So what are people going to do to get out of these bridge loans, or even if they have a Fannie or Freddie loan, they're going to have to get out of. So if you look at actually the interest rate, the average interest rate across all these loans that are coming due is 4.82. So there's going to be a reset in rate for pretty much everybody, closer to the 6.5% range. So everyone's going to have to deal with these higher maturities. And so a lot of these people, if they've owned the deal for a long time, they have plenty of equity and they're just going to sell the deal. Other people, they won't have that opportunity. And so if you have a market that you're looking at, to me, this is where the opportunity lies for buyers in the next 12 to 18 months, is right here, is maturities that are coming up. And these are true market sellers, like the broker had said on that previous chart. All right, so interest rates, I feel like everyone tracks these interest rates every day. And so I moved it a little bit towards the back, but I mean, this forward curve has not really given up at all. It still has a little bit of juice. Some people are thinking maybe there's one more hike in November and then maybe it'll stop there. But the challenging thing is just how, if it stays up this high for so long. And this is really what's pushing the 10-year treasury. Also, is that if the front end of the curve stays this high, then 10-year treasury has continued to move up. And this has just increased your interest rate cap costs consistently. So if you want to buy a 3-year cap at 2%, most people are buying anywhere from 2 to 3% because their spread is typically 2 to probably closer to 3%. So if you want to be in the 5 to 6% range, in terms of an interest rate, you're going to be in this range. So you're going to be anywhere from 5 to 7 to 8% of your loan amount upfront. So it's almost like buying another year or paying another year of interest right at the beginning. Most people, if you look on the bottom right, most people have not, they're still thinking they're going to hold for, probably 6 months, 7 months, and then maybe a cut towards the back half of 24. So 10-year treasury, I mean, this has definitely been the story over the last month, is just how much this thing has run. And, I snapshotted this before recording and, it's close to 4.7 now. People are looking for a little relief. I mean, I had to go back a while. So 2007 that it was this high. So I started in multifamily really in 2015. Most of my time here from 2005 to 2015 was at GE, and I did not have nearly as much money invested in multifamily as between 2015 and 2023. So um, this has definitely been a very different feel as these rates have risen. So we're just gonna have to wait and see if we get any relief on this 10-year treasury, or it's going to become very difficult for people to refinance out of their assets. The in the bottom, this is from Pinsford's latest webinar. They have 2023 ending at about 4.07 and 2024 at 3.8. So, pretty similar to that forward curve in terms of the 10-year treasury. Why are they pushing on interest rates so hard? It really is to get inflation down. And, this is from the Pinsford webinar, but, in the 70s, there was really two, Pinsford called it, K2 and Everest. And, this is where it has, we made a run up here, and they just do not want to see this Everest up here and just the second wave of inflation. And they're just going to keep that interest rate at that high level while they look at the month-to-month data compared to the 40s. They compared this to the 40s, and it looks like just after that it just pretty much stayed at zero or below zero. So they just don't know which one it is, and until they figure out that this is down for a couple years, maybe then they'll feel comfortable before letting up on it. So a lot of people are calling for a soft landing in terms of the economy, and this chart shows that almost all the soft landing calls have called the next recession. So the number of soft landing mentions is very high right now. Good news is bad news, or bad news is good news. So if there is a recession sooner, then the Fed will start cutting rates sooner than predicted. So. But my background, I was born and raised in Houston, went to school in Austin at UT, was an underwriter for GE for 10 years, and then been focusing on multifamily for the last since 2015, so the last 8 years, and then invested in a number of properties across all the metros in Texas. So let's get into the multifamily side, how deals are getting done on the financing side right now. Freddie Mac SBL is definitely moving up. They can come out at any time with increases. So they're I think in 2 weeks, they probably raised 15 and 20 basis points. So probably close to 7 right now. Fannie and Freddie, depending on the affordability of the deal, you're probably 6 to 6.5. If you want any sort of yield maintenance or anything like that, or shorter yield maintenance or step down prepay, it'll be higher. Non-recourse bridge, their spreads have stayed about the same, but your interest rate cap costs have increased. So, we're still doing some bank loans out there. I would say prime is right around 8.5. And so you're plus or minus probably 50 basis points from there, depending on your relationship with the bank. But smaller deals are still getting done with bank loans, especially if they are in some sort of distress or can't qualify for agency loans. Freddie Mac SBL, we're seeing, this is probably on, I think this is on 65% leverage, but if you went up higher to 75% leverage, or if you could use a 125 cover, this will probably be closer to 7. But a lot of people are still using these loans on the Freddie Mac on the smaller side, SBL. And in conventional, the one thing that is sort of filling in the gap, right? When you're talking about the first mortgage, let's say you have a existing current loan of 10 million. And then now the new loan can only get to 8 million. There's still that gap of 2 million that you're going to have to either raise with a capital call or put in preferred equity. So we're seeing Freddie Mac be okay with some preferred equity behind you. And here's some of the terms. You're probably looking at anywhere from 10 to 14%, and you're going to have to pay 5 to 6% probably in terms of an interest rate, and then you would make up the accrued amount on the back end when you sell or refi. And Fannie Mae. So we just closed this loan, Fannie Mae over in Euless. Similar, because this was a deal, it was a little bit closer to that 5.5 to 6% cap rate and interest rate. And then affordability is going to get you a lower spread on it as well. And so Fannie Mae, we're seeing them become a little bit more flexible on pay rate on preferred equity as well. So the main difference between these two, Fannie Mae and Freddie Mac, is Fannie Mae is going to want a soft pay and Freddie Mac is going to want a hard pay. Or the preferred equity guy wants a hard pay, but Fannie Mae is going to want that soft in terms of preferred equity behind you. And this last one is really the recourse bank loans and where they sit today. So I would build in probably at least 5%, if not 7 or 8% for your strike rate if you do a bridge loan. In terms of deals closed at Old Capital, I mean, last year we did probably over $1 billion. This year we'll probably do $500 million. So just with the number of transactions being down, and it is harder to do acquisitions, harder to do refis, the volume definitely is a little bit lower this year. All right, so in terms of Old Capital, why work with us? I mean, obviously there's going to be a lot of different buying opportunities out there. So we are sort of on the front lines right now in terms of seeing a large number of deals. So definitely reach out to us and we will sort of get your team ready, because I think what's a little bit different right now is just that you have to move quick. You're not going to have as much time to sort of get your team together compared to just a normal market. They're going to want to choose, a seller's going to want to choose somebody who they know they can close. They know they can qualify for the loan. They know they can raise the equity. Because right now, if a deal goes on the market and doesn't close, then it goes back on the market, it's going to be rather difficult for someone to step in and buy that deal. And then if you have not registered, this is this week. So if you're in Dallas or can get to Dallas, October 4th and 5th is our big conference this year. So definitely go on to oldcapitalconference.com and register for that event if you can make it. And then definitely subscribe to the channel, like, comment, share this video. Try to do it once a month in terms of our webinar. And then if you need help with a term sheet, send me the T12 rent roll OM whisper price and we can get you that. And then if you're just getting started and want to just review, buying, selling, refinancing, set up some time to go through a personal financial statement, I can do that. And then if you're interested in joining Old Capital, send me an email with your resume. And I will talk to you guys at the conference or next time at on the next webinar. All right. Talk to you then. Bye.